Asian markets mostly rise amid growing concerns over Donald Trump's second presidency. Chinese property developers face another year burdened by debt and liquidation petitions. And we look at the space economy as more companies seek to secure their spot in the cosmic race. Hello, I'm Taiba Aiden with the latest business and finance news here on TRT World. Asian markets mostly rose on Tuesday, with key indices in China and South Korea climbing while Japan's Nikkei dipped. Meanwhile, India's inflation data points to potential rate cuts, but the rupee's record low adds pressure. And in the US, the Dow outperformed as investors shifted focus away from tech stocks. Hong Kong's Hang Seng Index surged 1.4% and mainland China's CSI 300 climbed 1.74%. Meanwhile, Japan's Nikkei 225 bucked the trend, slipping 2.1% alongside a 1.48% dip in the Topix. South Korea's Kospi gained 0.25% and the Kosdaq rose 0.85%, reflecting a mixed yet optimistic trading day in the region. India's inflation eased to 5.22% in December, marking a second consecutive monthly decline. The weaker rupee, which hit a record low against the US dollar, remains a concern for investors. Analysts anticipate this could bolster the case for future interest rate cuts by the central bank. And over on Wall Street, the Dow Jones soared over 300 points as investors moved into non-tech stocks like Caterpillar and JP Morgan. The Nasdaq fell 0.38%, dragged down by a major tech sell-off. The S&P 500 inched up 0.16%, capping a mixed session for US markets. Let's get more on this now with Dilin Wu, research strategist at Pepperstone. Good to have you on the program with us, Dilin. Now, what's driving the differing performances between Asian and US markets?
Well, I feel like if we're currently talking about the forex market, there's no doubt that the US dollar is currently the best performer with few comparable alternatives among other major currencies. And the dollar is not only offering us some yield and relative growth advantages, but also, serve as a hedge against potential tariff risks supported by both trends and momentum. So that's why I feel like we've seen the dollar break through some technical resistance against like a Swiss franc, Swedish krona, Australia dollar, among other major currencies. And if we are looking in a broader perspective, or if we're talking about equity market, I think the difference is major between the difference in the economic look between US and other economy like China, because China keeps trying hard to reduce their interest rate and inject capital into their equity market to boost the economic performance. But to be honest, we haven't seen much results so far. And also like other major economics like Japan, we're still not sure if the Bank of Japan will increase their interest rate by the end of this month. So I would say in a general perspective, this is because the difference in our economic perspective from US and other China, like including Chinese market and other Asian markets, that caused the performance differentiation.
And you say we haven't seen much of a result from China's measures. In your opinion, what more needs to be done?
Well, if we're looking at the internal economic environment, China's recent stimulus measures haven't really delivered a significant impact on the economy. I mean, for example, the latest December CPI data showed a modest 0.1 year-on-year growth, and PPI even remained negative, indicating ongoing deflationary pressure. And from an external risk perspective, last week, Trump emphasized his tough stance on tariffs. Although China's export surged by 10.7% in December, this could be quite a result of front-loaded exports in anticipation of tariff impact. So I personally believe that in the medium term, the trade friction and some tariff negotiations between China and US could create more obstacles to Chinese economic recovery. So in the near term, I think we can have more information from the National People's Congress in the upcoming March, which we can expect more stimulus measures from the PPOC and also the Ministry of Finance.
Okay, Deline Wu, research strategist at Pepperstone. Thank you very much for that analysis. Now, staying in China, property developers are entering another year weighed down by liquidation petitions and mountains of debt. The nation's real estate crisis, now in its fifth year, shows few signs of easing, leaving many builders struggling to stay afloat. One of the most talked about stories is that of China Evergrande, the world's most indebted property giant. On Monday, a Hong Kong court ordered the liquidation of one of Evergrande's key offshore units. The move adds to the mounting pressure on the company already dealing with billions in liabilities. Other property companies, including Sunac, Country Garden, Times China and Shimao, are expected to face similar legal issues soon. On Friday, both Sunac China and Shimao received liquidation petitions underscoring the growing severity of the crisis. Over the past 5 years, the S&P China Real Estate Index has dropped from around $2,000 to nearly $800. Housing sales from the top 100 builders fell by 28.1% in 2024, worsening from a 16.5% drop in 2023. And despite Beijing's efforts to stabilize the market by cutting mortgage rates, easing buying rules and lowering taxes, these moves haven't had much effect. The real estate sector is still struggling, and it's unclear when or if things will turn around. For more on this, we're joined by Andy Mok in Beijing. He's a professor at the Beijing Foreign Studies University. Good to have you on the programme with us, Andy. Now, how has the world's most indebted property giant Evergrande's liquidation impacted China's broader property sector?
Well, thank you for having me. I don't think that recent developments with Evergrande or some other Chinese real estate companies, including Shimao, Sunac, have much impact on the overall situation. It's important to point out here that the real estate market, China's export machine, and its investments in infrastructure have been the three growth engines that have taken China from a poor, backwards country to the second largest economy in the world. And what we're witnessing here is indeed a crisis, I think, of gigantic proportion. So a little bit of perspective. China's real estate sector accounts for between 25 to 30% of China GDP. Global analysts consider it one of the most, perhaps the most important asset class globally because of the impact it has on demand for global commodities like iron ore, copper, etc. So it is very, very important. What is happening is having a severely negative impact, not just on China's economy, consumer psychology, but global commodity markets as well. But it's important to point out here that none of these developments, including Evergrande's liquidation process, is anything new. That this is a process that has been unfolding, as you say, over the last 5 years.
Right, and why haven't Beijing's stimulus measures been able to stabilize that crisis?
Yes, and I think that's a question that's often asked, especially amongst foreigners observing this, what I would term a fundamental transition. So the Chinese government is taking steps to stabilize the real estate market. But I think we also have to recognize that the government has concluded that this engine of growth, one of these three engines of growth that has delivered historic, unprecedented prosperity to the people of China, no longer serves this purpose. And as we're seeing, this is a profound transition, in some ways a very painful transition, away from an economy where real estate has been an important economic driver, a source of wealth creation, wealth accumulation as a major asset for Chinese families, to one that is driven largely by productivity increases. So I think the core question that one ought to pay attention to here is how is China, as largely a state-led economy, able to manage this transition? Now, many Western economists are deeply skeptical. But at the same time, if we look at China's track record of defying the Western skeptics over decades, I would not consider this to be an unachievable transition. Certainly, it's a challenging one. And this does have long-term ramifications for the real estate sector in China, in that any expectation to the boom years or the go-go years may not be very realistic. And a stabilization and perhaps a modest improvement may be the most realistic outcome we can look for.
Right, and we will find out what more is to come for China's property sector in the coming days. Professor Andy Mok there from the Beijing Foreign Studies University. Thank you very much for joining us.
Thank you for having me.
Now, a quick look at some of the other top business stories from around the world. The Bank of Japan's Deputy Governor Ryozo Himino raised the possibility of an interest rate hike next week, acknowledging that getting the timing right is tricky but crucial. This follows the biggest rise in wages in 3 decades. Himino pointed to steady wage growth and the expectation that US policy would become clearer after President-elect Donald Trump's speech later this month. Despite the hint of a rate increase, the Japanese yen barely moved. Global sales of fully electric and plug-in hybrid vehicles surged by 25% last year to more than 17 million units, with December marking a record-breaking 4th consecutive month of strong sales. China's continued growth and Europe's stabilization played a key role in the rise, fueled by incentives and emissions targets. In 2024, the UK overtook Germany to become Europe's largest battery electric market. The US government has announced new restrictions to artificial intelligence chip and technology exports as it looks for new ways to block China's access. The new rules will cap the number of AI chips that can be exported to most countries who could use them to threaten the US. The Biden administration said 18 allies and partners were exempt from the restriction. Now, Jeff Bezos' rocket company Blue Origin had to abort the launch of its first orbital rocket, New Glenn. The company postponed the launch, citing a vehicle subsystem issue. It comes at a time when more and more companies are moving to lock in their positions in the space race. Emre Boz reports.
For this rocket, there's no liftoff. The latest attempt by billionaire Jeff Bezos to get his latest spaceship, the New Glenn, off the ground.
We are standing down today's launch attempt to troubleshoot a vehicle subsystem issue that will take us beyond our launch window. We are reviewing opportunities for our next launch attempt.
But it's not just Jeff Bezos' Blue Origin investing heavily in the space launch industry. Other companies like Toyota are now making headway. The company's research unit has invested $44 million in Japanese startup Interstellar Technologies, looking to expand into the space sector. And Toyota is also set to work with Japan's space agency to build a lunar rover hoping to carry astronauts on the moon's surface.
Because when it comes to what's possible when we work together, the sky's the limit. And speaking of the sky, we are exploring rockets too. Because the future of mobility shouldn't be limited to just Earth, or just one car company for that matter.
But for now, one company is dominating rocket launches, and that's Elon Musk's SpaceX. And as he dominates, so too is the company's profits from the venture. His space company, SpaceX, increased its market cap to $350 billion. This is after SpaceX and its investors bought $1.25 billion worth of shares within the company, adding $20 billion to Musk's wealth. SpaceX is dominating the space industry, taking top spot in the number of rockets launched in 2023. That year saw the number of launches at 96. To date, it has 7,000 satellites up in space. The space economy was worth just under $600 billion last year, expected to be worth $1.8 trillion by 2035. This is as demand for satellites and rocket-enabled technologies increases. So for these companies entering the space race, they're hoping to receive dividends to infinity and beyond. Emre Boz, TRT World.
For more, we're joined by Francisco Diego in London. He's a lecturer of physics and astronomy at University College London. Thanks for being with us, Francisco. Firstly, let's talk about New Glenn. Tell us more about why its launch was postponed in the first place.
It's not very clear. They say there are a series of problems there, and they were postponing it every few minutes until the window for launch was lost. And they were planning to postpone it for 24 hours. It's not very clear what happened. I couldn't find any information about it.
Right, now the space industry is currently dominated by Elon Musk's SpaceX. How has he managed to achieve that? And does Blue Origin realistically stand a chance in competing?
Well, it is different. I mean, they in the United States, there is a lot of competition with companies. And yes, SpaceX is going ahead with the Falcon rocket, for example, which is the workhorse that has been keeping alive in a way the International Space Station, and now launching thousands of satellites for communications and other purposes as well. So yes, it looks like SpaceX is going ahead, and with less problems really, as we see now with Blue Origin, the Blue Glenn rocket having problems as it starts. Is the first orbital rocket from Blue Origin that I hope it takes off in the next few days.
And the space economy is expected to grow to $1.8 trillion over the next 10 years. What new projects are on the way and how are they being financed? And we've also got some new key players entering the market.
Yes, it's a big problem, really. I keep saying in these interviews that we really need a very strong regulation, because it's going out of scale, out of control when we have private enterprises, and then hopefully, I mean, they will work with their proper countries' space agencies, like the Toyota working with JAXA, with the Japanese Space Agency, and Blue Origin and SpaceX with NASA. And the European Space Agency also comes into play. And also, we shouldn't forget China, Russia, and India, who are very strong players in space exploration. So all these players need to come together, really, to, as the Toyota chairman said, we have to come together and explore space together, because it is important. Space is a very dangerous enterprise. Once we put astronauts in the rockets, then we're playing with human lives, and it's not the same. One thing, and the other thing is, of course, the amount of satellites and space debris which is around the Earth that needs to be regulated. We are risking to reaching what is called the Kessler syndrome, where you have so many debris and then collisions between debris, and then it's going to be very difficult to clear that. So we really need very strong regulations.
Okay, Professor Francisco Diego from University College London, thank you very much for your time.
It's a pleasure.
Israel's war on Gaza has left deep wounds on the region and dealt a major blow to its economy, and many Israelis are feeling the financial strain. From tax hikes and rising prices to a skilled workforce exodus, the effects of the prolonged conflict are becoming harder to ignore. Mohammed Al-Qasim reports from Tel Aviv.
Israelis are welcoming the new year with tax hikes, soaring prices, and spending cuts. Ordinary Israelis are feeling the pinch due to a bleeding economy, ballooning budget, and out-of-control deficit. The parliament recently passed a significant tax increase. All this is a result of its months of war on Gaza.
The Israeli citizen is going to go into a year of difficulty. A significant part of it is the war, because we have massive expenses for the war. We have we have large numbers of population that left their houses, whether it's in the south near Gaza or in the north near Lebanon, and we need to support them, which costs a lot of money.
Here at the famous Carmel market in Tel Aviv, sellers complain that sales are down.
all things all make up price. Today, the simple thing, is today you pay 5 shekel, today you pay 12 shekel. Tomorrow you pay 15 shekel, 80 shekel.
Tourism has also taken a massive hit, with arrivals down sharply in 2024. Israel's tourism ministry has estimated that the drop in foreign tourists will deprive the treasury of more than $5 billion in lost revenue since the start of the war.
Now, no tourists. No tourists. Not very much.
With more than 15 months into the war on Gaza, Israel's economy is facing its deepest decline in years. Markets like this one are usually buzzing with shoppers spending money, but with tax hikes and high prices, people are spending less. It's less busy now, with people worried about how far their money will go. What's worse is the country's deficit is up, credit ratings are down, the tourism industry is flailing, as well as the construction and agriculture sectors.
Business was devastated. We have no more tourism. Tourism was basically erased. The high-tech sector, which is Israel's locomotive, it had a good year financially, but we see problems there with money coming into Israel.
And with war raging, more than 82,000 Israelis left the country in 2024, in stark contrast to previous years. Israel is facing a brain drain. The vibrant high-tech sector, the main engine of the economy, its labor market is shrinking, with many skilled workers leaving the country. The Gaza Strip is in ruin, with tens of thousands of Palestinians killed, most women and children. Countless lives are shattered. Gaza is reeling under an Israeli onslaught that has lasted for more than 15 months, and the nightmare continues. As for Netanyahu, he has vowed a total victory in Gaza before the war ends, and if wars were measured solely by their economic impact, many argue Israel's economy has lost the war. Mohammed Al-Qasim, TRT World, Tel Aviv, Israel.
Meanwhile, the Arab League has shown support for Nawaf Salam as Lebanon's new prime minister. 2/3 of lawmakers backed President Joseph Aoun's choice. Salam is expected to focus on forming a government to address Lebanon's economic crisis. Randolph Nogle has more.
After years of stagnation in the political wilderness, Lebanon has found a new path. And the country's new president, Joseph Aoun, is wasting no time in taking the first steps to form a new government, holding consultations that at the end of the day produced a new prime minister.
The natural choice for us is Ambassador Nawaf Salam, because in him we see the face of reform.
Nawaf Salam, a former Lebanese ambassador to the United Nations and current presiding judge at the International Court of Justice, was the decisive choice, to the dismay of Hezbollah and its ally, the Amal movement.
Once again, some are plotting to divide, fragment, cancel and exclude out of stubbornness and malice. We took positive steps in electing the president, and we were hoping to find an open hand being extended, but instead, that hand was cut off.
Hezbollah is believed to have been pushing for incumbent Prime Minister Najib Mikati to form the next government. Lebanon's lawmakers have opted for a technocrat in selecting Nawaf Salam, someone whose career hasn't been embroiled in the country's divisive sectarian politics, someone who's internationally respected and is guided by the law. One of the most interesting implications of today's result is that Hezbollah, which has wielded outsized influence in Lebanon for decades, may be witnessing its influence diminish. In recent months, Israeli airstrikes have decimated Hezbollah's weapons infrastructure and dismantled its leadership, including the assassination of Hezbollah Secretary General Hassan Nasrallah. The group is facing an uphill battle of rebuilding its ranks, with a key ally in the Assad regime in Syria now overthrown. Nawaf Salam is expected to assemble a new government in the weeks ahead, one that many in Lebanon hope can restore the country's sovereignty and pull it out of a severe financial crisis while maintaining a fragile ceasefire between Israel and Hezbollah threatening to collapse. Randolph Nogle, TRT World, Beirut.
Well, that's all your business news for now. Thanks for watching.